Good morning, good morning, good morning. How are you guys today? It is another great day. Great day. Donald Trump is alive, and he is not dead yet. Not dead yet. Come on, fight. I'm not dead yet. You guys ever see that Monty Python show where the guy that soldier, the knight sits there, he's in a fight. They cut off his arms, they cut off his other arm, they cut off his leg, cut off his other leg, and he's like, I'm not dead yet. Come on, fight. I'm not dead yet. That seems like Donald Trump. Holy cow. What do they do to this poor guy? And he's still saying, fight. I'm not dead yet. All right. What a weekend, guys. Did you guys see that video of the prophet, of the guy that had predicted that this would happen? Oh my hell, he predicted it right down to the event. He's like, this guy, they said, he's like, and this was back in April, and he published it on YouTube. He's like, they're gonna attempt assassination on Donald Trump, and they're gonna shoot a bullet right through his ear, and it's gonna come so close to him that it's gonna take his ear off, and it's gonna break his eardrum. That's how close the bullet's gonna come to his head. He's gonna fall onto his knees, and then he's going to pray to God while he's on his knees, and he's going to stand back up, and he's going to come up triumphantly. Did you see that guy's prediction? Oh my gosh, he predicted a few other things too. You should search, if you haven't seen that, you should search that on YouTube. Guy that predicts the assassination of Donald Trump, the assassination attempt. That is the craziest thing I ever saw. The guy predicted it just exactly the way it was going to happen. 3 months ago, back in April, May, June. Yeah, 3 months ago. All right, guys, we're here with the S&P 500 in the upper left-hand corner. We got the Dow in the upper right-hand corner. We got the Russell in the bottom lower corner. We got the NASDAQ in the bottom right corner. Now, the markets have been going crazy this past couple of weeks, and our wild eye, crazy eye, neutral option strategies haven't been the best strategy for that. And one of the best strategies when your market's going crazy up is just a simple long call. And we published an article today at 10:30. Fed Chair Powell is going to speak again, and I have no idea what he's going to say, but he's been very positive in the most recent conversations that he's been having, and the market's been taking off and going up quite significantly. So I wanted to talk just a little bit about what if we just put on a straight long call on the open. Now there's the opening bell. Look at the markets go. So we're going to do a little scalping trail here at first, and then we're going to go put on a long call. And we should probably put on our long call right now. We know that the market has a tendency to rally. Look at this. It rallied starting back at 9 o'clock p.m. last night. Like that's last night. This is the middle of the night. And then, of course, this morning, 6:30, 7:30, this is, it stopped going up. That was at 5:30 this morning. But man alive, from 9 until 5, that was the middle of the night. So this thing's been going straight up. I think what we're going to do is we're just going to come in here, and we're going to go into, and we're going to do a one-day call. We're going to buy just a single day call. All right. We're just going to buy a call in anticipation. We're going to do 1 day because it'll maintain its, and it's $800. So we're going to go in there. We're going to buy that. I'm just going to put that on right now. Okay. So we're just going to leave that on there. It's going to cost us $800, but that's for 2 days. All right. Not for 1 day. If we did a single day, we could lose the entire premium of $600 in 1 day. But where we put on a second day, we got that second day for only $200. Okay. But it's to the long side. The market has to go up. But you got the second day for $200. Think about that. If you would have bought a 0 days till expiration option, just a long call, it would cost you $560. But we bought one for $800. So that means we got the second day for only $200. All right. That's a good deal. So now we're going to come in, and of course, we need the market to rise. We need the market to rise. Now, it'll probably, knowing the market, we should have thought about this a little bit sooner. But market will probably have a tendency to fall before it starts to rise. It'll probably make a little bit of a Fibonacci retracement off of this thing, and then it'll probably rise this afternoon. But that's okay. If it does that, we'll dollar cost average. We'll put a second one on. All right. We're not afraid to put a second one on. But if it takes off and goes out of the opening bell, then that's okay too. That's what we'd like to see. Now, let's draw our cone of probability. I want to draw a cone of probability real quick. We'll do the option here first, and then we'll go do a little scalping trail. All right, this won't take long, and it'll give us some time to scoot this market down a little bit, and then we can go do a little scalping trail while our option works. But I want to show you the delta cone of profit. And it's not the cone of probability, it's the delta cone of profit. Oh my goodness, this is range 6. We got to scoot this chart down a little bit. Let's come in here, or let's go to a 2-minute chart. All right, so we're going to come in here, and here's a high. Look at this. This is an important number for us right here. That was 715. Oh, that was this morning. All right, so we're going to look for this market to rally today. Now, it might go a little bit sideways this morning, waiting for Powell to speak. He's going to speak at 10:30 my time, Mountain Time. So that's 12:30 Eastern. We'll see what this call does. We'll see what this long call does. All right, so we're going to put that on. We got 2 days on that long call. And my goodness sakes, where's my expiration time frame? Clear out there. All right, so how much that thing costs us? Now remember, this is not for today. Let's it's a 2-day expiration. That's why let's go out to a 15-minute chart. We're gonna have to go to a 15-minute chart. See if we can get our second. There it is. There's our cone of probability. Delta cone of profit is what we're going to call that. All right. So here's today's market close. Here's your expiration tomorrow. So if we were to do a wild eye, crazy eye, iron butterfly, which you're all familiar with, we've been doing those a lot, right? So if we come in here and we do, and let's say we did just a wild eye, crazy eye, and we collected $1,000. So let's just do what we normally do. So we come in here and we collect $1,000, which would be right about there, right? $1,000 per. And then we take our measuring tool and we go from here to here. Just square those up, draw your measuring tool. That would be your cone of probability. Now, this is what you're typically used to seeing me do, right? When we do these neutral option strategies. I don't know, maybe today would be a good day for this, but we're going to do a long call. So that would be your cone of profit, right? Wow, that's a bright green color, Lan. You got a bright green color in there. You're scaring everybody with that bright color. Let's do a dark green, dark yellow. There we go. Oh, we got to do both of them. Dark yellow. There you go. Let's make this one a little, just normal green. Okay, so that's a little better. So that's our cone of profit. And if you're going to sell options, but that means that if you're going to buy options, if you're going to buy a straddle, right, or a strangle or a straddle, you got to remember that the strangle is the gap, the straddle is on top of each other. So the straddle, if we're going to do a straddle, this is what selling a straddle would look like. All right. So that would be your profit if you're going to sell a straddle. You're going to collect the premium of both, and the market would just have to close inside of there today, and you'd keep your full $1,000. All right. Now we bought an option that's going to have an extra day on it, but we're going to play off of 1 day. Hold on, I got to drink some tea. All right, so this is what we're going to look at. So if we're just going to do a long call, we have to still do a delta cone of profit, right? So our delta cone of profit, what did we pay for on this thing? We paid $800. So we're going to have to draw our little dollar calculator up $800. So let's come way out here, and it's going to be right there. There you go. All right. So now we didn't do both sides. We only did one side. So our delta cone of profit is right here. So we're going to come in here and we're going to draw like this. And this, instead of being green, needs to be red. Send back, Lan. Send back. All right, so that is your delta cone of loss. So we're going to turn it red now. Red, 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 red. Red. Let's make it dark red. There you go. Okay. So that's your delta cone of loss on this strategy. If it's in closes inside of that red box, you're going to lose money. Okay. If it's outside of that red box, you're going to have the opportunity to take some money off. Okay. But it's not going to expire until right there, which is tomorrow at close of business. Now we've lost $800. So look what's going to happen here. Right here and towards the close of business today, we're going to have a much smaller cone of loss. So we're going to have the opportunity to pull money off in here. This is all profit up in here, right? We don't know how much. I mean, we could go do the mathematical calculation on that little online calculator, but it gets really ugly until expiration. At expiration, we know the delta goes to 1.1. That's why we always calculate everything at expiration, right? We always calculate everything at expiration because delta at that point goes to 1.1. Anytime in between here, and here, delta could be anything. I mean, it's going to start out at 0.50. So it's going to start out at half, and it's going to move towards delta 1.0. If you don't know what delta is, I've got other videos on that talk about delta. So go search my website, my live videos that talk about delta, and you can have a delta lesson. You could also, of course, shameless plug, you can go to tradementors.com and you can sign up for my options course where we teach you all that kind of stuff. And then you and I will work together one-on-one to help you understand this stuff. If you're really interested in this thing and you really want to do it, it's like flying an airplane. You can come in here and you can learn on your own by watching other people fly. And that's a good way to learn. And I would, expect you to do that. But if you want an instructor to help you fly your airplane, which is probably a good idea, I mean, especially if you're going to risk your life flying around in an airplane, you probably ought to have an instructor help you get your license. What do you think? And I'm an instructor. That's what I do. I teach classes at the university. And I know not everybody can come to the university for my classes. So I put my classes online and teach them as people need them. So if you need to have a class, you want to take a class that I teach at the university, teaches you all this stuff, and you and I work one-on-one, then go take my class. You can sign up for the class online at tradementors.com, and I'll help you learn this stuff. All right. And then you can come back and you can watch us here. This is the lab for my classes. And that's why we have students from the university and from my private club in this class. All right. So that's who's in here. This is the lab. This is where we come and practice what we preach from the classes. Now, if you don't want to take the classes, you just want to come to the lab, good for you. Come to the lab. You're going to learn a lot of stuff. But to know the academic side of trading, the academic world, and the understanding what we're doing, and you can get an accelerated education, you can go pick that up over at the university, Utah Tech University, if you're close to St. George, Utah. And we do that. My first classes will start this fall in October. And you can come and join us there. Or, hey, you're not close enough to come to St. George, Utah and have live classes with me, go join me online at tradementors.com. You can sign up for the same classes, and I'll work with you one-on-one to help you get through those courses as well. All right. So what we're doing is this is the cone of probability, the cone of loss on this thing. Remember, you have the premium that when you buy an option, the market has to move far enough to pay for that premium. All right. You have to pay for that premium. So the market has to make enough money to cover the cost of the premium of the option. And that's what this is doing. So at any given time, as you go further and further in time, you have to make more and more and more money until expiration of that option. And that's when you're going to, if it's inside of there, you're going to not make any money. All right. You're going to lose the entire premium. That's your break even point. Anything below there is going to be a loss. You're going to lose on your premium of your option. Okay. So that's how it works. At your cone of loss, you're going to lose. Now, what they're going to do is they're going to assign you a position. So let's say that it comes in here and you paid $800 and it closes right there inside that red line. Well, they're going to assign you a position right at this level here. So you would have a profit on the position of anything up to where you made money, right? So that's how this works. You'd make some money You'd make like $300 if it closed out inside that red line right there. You'd make money. All right, you'd make $300, but you paid $800, so you would lose $500. So that'd be a $500 loss against your position, and they're going to assign you a position right there. Now you can wait until the end and you can close it out right, 30 minutes before the market closes. They're going to give you pretty close to a $500 loss. All right, you can take a $500 loss on that trade if it's inside there, anywhere inside there. Otherwise, you're going to get that much money. Now, if it's below the purchase line, anywhere down here, we should be a little bit more accurate. If it's anywhere down here, all right, we got to change that. That's going to be red, 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 red. Red, 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 red. That's going to be loss too. All right, so anywhere in here is going to be you're going to lose money. But if it's above the green line, at least you're going to make a little bit of money. You're just not going to make enough to cover the cost of the option. You're still going to lose money. But you could wait for them to assign you a position and then hold on to the position. And if the position rises, you could do that. But remember, if you hold it for multiple days, then you have to. We had this conversation with Lowdown Killer. He was asking this out in the forum, out in the question and answer thing on the video the other day, and I tried to give a little bit of a description on this. So trying to cover that a little bit here. But if you want to see my written description, it's out there in Lowdown Killer's question. All right, but your margin is going to go way up. See that? Our margin goes to $13,640. So if they execute or they give you your position, then and you're right here, you're down $500, and you're like, well, I'll just hang on to it in case my position rises. Okay, well, if it's a position, your margin is going to jump from a daily margin of $750 up to $13,640. So you're going to have a margin call if you don't have 13 grand in your account. So you got to keep that in mind too. So you got about a 15-minute window. You can liquidate that thing as soon as they assign it to you. They're going to assign it to you as close to the top of the market as they can, which is on close, which around here is 2 o'clock, right? 4 o'clock Eastern. And then that's what they're going to do. They're going to assign you a position, and then you're going to have a margin call if you don't have enough money in your account to cover the position. So keep that in mind. You're going to need to, if they assign you, you got until 2:15 our time to close out that position before you get your margin call. So be mindful. Be mindful. I would just close out early. Just close it out early. All right. Just close it out about 30 minutes before. And you're going to take your $500 loss in this case if it closes right here. All right. Unless you got the 12 grand, then you can just hang on to the position and let it ride and see if it wants to continue higher. Of course, put your stop in there, and if it falls, then you lose, and you get stopped out, and you lose $500 on the trade. That's how it works. That's how it works. Now look at this option. This market ran way up here, so we were in the green. And now it's flushing back down into the red. It's below our strike price. Anything down here, this is loss, right? This is all lose, lose, lose. And this is make a little bit, just not enough to cover the cost of the option. Now, if it comes up in here, anything up in here, this is going to make you money. You can close out a profit. Now, if it goes right up that red line, you're going to be right at break even the whole time, right? At break even as it goes all the way up that red line, right? All the way up that thing, you're going to be break even. So we need this thing to be smart and rally way up in here. And then this is what we're looking for. And then we could close out a position. All right. So that's how this works. All right. So we've got our long call. We're just going to leave. Oh, it's flushing right now. This is not good news. But what's the maximum amount of money we can lose? The maximum amount of money we can lose is the premium we paid for the option. So how much we pay for this one? So we actually, let's come down in here. Oh, my goodness. I can't grab my tools. Okay, send to backland, send to back. Okay, so we're going to come in here, and we paid $800 for this thing. So if we bring this down, we got to put it at $800. That's the maximum amount of money we can lose. So I drew our loss box too big. All right, so there's our loss right there. We could lose $800. Now, this is going to be kind of a wedge too. I mean, it's not exactly. We're not going to lose the full $800 right here. You can see if we look at our accounting. We're down 162, not 800. All right. So it's going to have a bit of a cone as well. So we could actually come in here and draw our cone of loss like this. Could be more like this, right? We lose the full 800 at expiration. So we got a loss cone that's something like this. Oh, and then I delete it. My goodness sakes, man. One of those mornings. Okay, draw your cone in there. So that really ends up being our cone loss, right? Now it's dropping out of the bottom of this thing really hard. So the maximum we can lose is this line right here. We can only lose $800. Can't lose any more than that. But if it comes down real fast right here, it's not going to lose $800 in the first, few minutes because it's got all that time value still involved. So that's why we're down $150, but we've got all this time involved. All right, we still got a lot of time for it to come. And of course, anything done in here is going to be a loss. It's going to lose money. But this is at expiration. All right, so that's how that works. So we want it to be up here. This is our cone of profit up here. So let's draw our cone of profit up here. Now we have unlimited profit potential. There's no limit to how much money we can make. So we could draw our cone up in there, right? And it could be a way up there. That's not a good thing. It's not a cone. It's a square above that market. So anything above there, that's all profit up there. All right. So the market's whipping back and forth. It's coming back up. We'll just let it play out. We're going to hold on to this thing till the end of the day. We're going to see where it's at the end of the day. Now we could come in and we could say, look, I want to come in. I want to liquidate the option, and I want to receive. When I liquidate, I'm happy with 25% profit. Right. So we could come and do the same thing that we do with our wild eye, crazy eye, iron butterfly. We come in here and say at 25%, there's 25.71. We go down one, it's 24.29, 25.71. That'd be $225. So if this option makes $225, we could put an order in there and just say place order, and we take it off. So if it ever makes $225, which is 25% of the value, which is the same thing we've done only in reverse, right? Because we're selling premium as opposed to collecting premium. I mean, collecting premium as opposed to selling premium, buying premium. So we could take it off at 25%. So you could do that too. Or you could just say, hey, I'm going to hold on to this baby clear until the end and see if this market doesn't just rally way up in here and make me lots of money. Because anything above at expiration, above that line is profit. So if it's up here, that's $575, $600, $700. Now, how much do we sell these options for? Let's say that on a good day, we can sell options and collect $500, right? Let's say the market rallies. It's inside of that cone or it's outside that cone. The profit, we generally expect to make about $500 to $800 on our wild eye, crazy eye, iron butterfly. Well, for this market to make that much money, it would have to come up here. Let's say $850. It would have to be up here to make $850. All right. So that's how much money you'd make because it has to pay for the premium that you bought. I mean, you paid $800 for it, and then you want to make $800. So it has to move $1,600 because it's got to pay for the $800, and then it's got to give you the $800 profit. So that's how the call works. It's got to be clear up here to make you $800. Now, if we sell the premium of two options and it closes right dead center of this thing right there, you're going to collect $800 too. So that's why it depends on whether you think the market's going to go up or down or sideways. And if you think it's going to just stay inside of this red box right here, you should actually sell the premium instead of buy it. If you buy it, it's because you think the market's going to be above the red box. If you sell it, it's because you think the market's going to be inside the red box. All right. And because we can also do a single 1 day till expiration, this cone of probability would be a little bit higher. If we were to sell it, it's $800, right? $800. If we were to sell a wild eye, crazy eye, iron butterfly, the market would have to only stay inside of this box here. I'm going to make an educated guess right here. Does that look equal? So that would be if we want to do our wild eye, crazy eye, iron butterfly, we could sell some premium, $800. And if it stayed inside this box, we would get a portion of that $800, right? At least $400 plus whatever or minus whatever distance away from the market is would be the losing side. So let's say if it closes right at that yellow line, that would be max profit. Would make all one $800. It closed right there. But it just has to close inside that box. Then you don't lose any money. All right. That's your profit zone. So the closer to that center that it lands, the more money you make. So that would be if we sold the premium, it would just have to close inside that red box to be profitable. All right, so let's close that because that's not what we're doing. We're just buying a long call today. So just buying a long call, we're just going to expect or look for it to rally and get outside that box. Get outside. Oh, clicked the wrong one again. Oh well. We're going to go with it. We know that anything down here is all loss. All right. Okay, let's go and do some scalp and trail. See if the markets are moving enough that we can do a little scalp and trail in here. Let's get rid of this one. And we're just going to leave that. What happened to my profit box? Oh, did I delete? I don't know what happened. Did I delete the wrong one? I probably did. Oh, well, we got our long call and we got a pending order to liquidate at $225. All right. Let's go trade the NASDAQ. Let's scalp and trail the NASDAQ. It seems to be moving today. Now, I had somebody ask me this question, and I just happen to have it in the slide, and you guys are all familiar with this. So come and join us, but we got new people all the time. I'm going to come in, and I'm going to, uh-oh, what happened? I'm going to come in, and I'm going to show you this little, is it better? And it happens to be that this is the slide that I think produced the question. Is it easier to trade one or two perfect setups with larger position size, or is it easier to make lots of trades with smaller position size? So I say don't trade out of your league. When first starting out, only trade one or two perfect setups with the smallest position size. Don't bet the farm, grow into your pants. All right. So, or is it easier to make lots of trades with smaller position size? Now that comes down to what we've been talking about. Of my goodness, look at this market really rocking for us. So doing our scalp and trail strategy, right? So in our scalp and trail strategy, I'm going to come over to our trading tab. And I need to talk about what we did last week because last Friday I had the biggest losing day of the year, right? We had a nasty losing day because we dollar cost averaged into a rising market. We tried to catch a falling knife on the way up. So what did we do? We jumped on a rising market, and it didn't fall when we thought it would. So let's see. I wanted to talk about this. We have this strategy we call the scalp and trail, and we've been doing the scalp and trail. One price bar. This is the price bar scalp and trail. So this is our number 2 strategy. Where's 2? 1, 2. There it is. Okay. So I've got our limit set at 5. At our limit, attached limit set at 7. We're going to change that to 5. We're going to even make it closer. All right. So our scalp, but we're going to take a little bit. We're going to turn off the jump, and we're going to we're going to leave that at 20, and we're just going to trail up on the ATR. All right. So we're going to stop trail one price bar back for entry. We're going to only scalp 5, but we're going to come in here and we're going to change the quantity to, let's start a little bit conservative. We're going to start with a quantity of 7. All right. And we're going to come in here and we're just going to scalp one price bar back, first bar to rise. And we're just going to scalp 5 points out, but we're going to do 7 of them. We're going to see how this works. All right. We're going to try this a couple of times because the question was, why don't we do a larger quantity with a smaller move? Now, I generally on my scalp and trail, I do 7, but 5 is really tight, right? But if we do a larger quantity, the chances of us hitting our 5 is pretty high. If it just pops through, there we go. All right. So we just closed out $145. Now, there's no trail on this. This is just a straight up, oh, and you missed it. Oh, my goodness, because I was showing you the slide. We just closed out that position. It just hit, and we made $145. See that? So it just hit, and we made $145 because we did 7 contracts with a smaller size. All right. 7 contracts, smaller size. Now, for our scalp and trail, I'm not real comfortable putting on 7 in a scalp and trail. Doesn't mean we can't. We certainly can. But if you just wanted to trade a scalp just like this, just straight up scalp, all right. Now, we would have to win with this strategy because we've got 5 and we're risking 20. 5, 10, 15, 20. That's 4, right? So we'd have to win 4 times for every loss just to break even. We'd have to win 4 times for every one loss. If you could win more than 4 times in a row, well, then that's where you're going to make your money. But remember that you have to win 4 times in a row to make one loss. Now, if our goal is $500 a day, we could drop this thing in there. And if we could hit $500, win 4 times before we have a loser, we could stop and have our $500. We'd be done for the day. That's the name of the game, right? You're like, well, Land, why don't I just go until I make $10,000? Okay, well, do that then. If you trust it, if you believe it. But you got to remember, for every loser, you got to win 4 times. So, but you're going to go with a very small position size. Now, the problem with this strategy is that you're going to have slippage on this thing. You're going to maybe slip 1 or 2 points on the inside, and you're going to slip 1 or 2 on the outside. Plus, you got commissions and fees. So you might look at this and say, well, $144 to do that one time, that's pretty good. Yeah, well, take away your commissions and fees, whatever those are. Plus, you might get a slippage of 1 or 2. And then when you do this in the real market, they're going to do the same. They're going to slip you, maybe 1 on the in, 1 on the out. So you might actually only get 3 clicks plus your commission. You might only be getting 2 clicks, but I can guarantee you when you lose money, they're not going to slip you in their favor. They're going to slip you against you. So you might have to actually make 5 wins for every 1 loss. Okay. What happened? See, they slipped us 23, 6, and 17. So we lost 23. We made $6.43. Got to take your commission out. And then we lost 17 on the other. So they popped it back and forth because our limit order, stop order. Now I'm trying to work with the programmers to give us the ability to have, let's go in here. Let's exit this chart. Let's change this up a little bit. I'm going to make it, that should not have hit our stop. Let's change this. Let's be a little bit more dangerous in here. Let's go to 30. We're on the NASDAQ. This is a big market. Okay, let's try this. We can get the first, I don't know if the market's in an uptrend. I don't really trust it to come down 5 points. Maybe, we'll see. First candle to break a new low. And then once it breaks that new low, all it has to do is do 5 ticks and it fills our order. 5 might be a little aggressive. That's why I usually do 7, but we'll see. All right, let's go say hi to some people while we're waiting for this market setup. All right, Gary Thomas coming in at number 1. It's nice to see you, Gary. We got Bruce R. coming in at number 2. Bruce with the silver. And then we got Mark Boucher coming in with the bronze. Nice to see you guys. Okay, it filled. So now we're up $260. So yeah, all it has to do is just go 5 ticks. But you have to remember, you have to take your fees out of there. So there's 42, 42, 42, 21. So we did 2, 2, 2, 2, 1. All right. So we can try it again. Market's on the rise. So it'd be nicer to see it. See if we can't get an opportunity to get into the upside. But let's try the downside one more time. This is like what we're doing is we're playing off the trailing stop. Market has a tendency to come back, stop everybody out, right? And so when they stop everybody out, we're going to turn that into a profit. So let me get some tea again. Hold on. All right. So the theory here, and we just won another one. So there's another one. 7 contracts, 5 ticks, $445. So will this work in real money? Yes, it will. But you're going to have a lot more commissions. You have to pay those. And so the theory here is that as markets rise, people trail up behind the market. And so as more and more stop orders begin to trail, what's going to happen is it's going to have a force on the market in a rising market to pull back down and stop everybody out. All right. Now, it doesn't need to pull back very far. All it has to do is pull back far enough to stop everybody out. Well, this strategy is telling us, okay, what we're going to do is we're going to put a position in to take advantage of that where everybody else is getting stopped out. We're going to take a quick scalp. Okay, this is part of the scalp and trail. We're just not trailing. So this is the stop scalp. All right. So we're going to just take advantage of all the trailing stops. Oh, exit that quick. Get out before it screwed us up. Well, we would have won on that one. So the idea is that all we're going to do is we're going to do the opposite of everybody's trailing stop. So we're going to put in a trailing stop just like everyone else, only instead of taking a loss when the market stops us out, we're going to take a small profit. And you can't do a big one. You can't do a big one because the market doesn't oftentimes come back far enough to give you much more than just a few ticks because it's just stopping everybody out. Because as soon as it stops everybody out, it turns and starts to rally once again. So it's only got a few bars that it can go. Right? So you have to wait until you get a bunch of people in there, start to get in, start to trail the market up. Okay, we got our rally. We're along the market with our option over there on the other side. It's making $0.00. There it's making $12 on our long option. We're up 445 on our scalp and trail, but we're doing quantity 7. We don't usually do. Oh, you can't see that either. Let's get this out of the way. We usually don't. Where? How the heck am I doing this? Oh, over here. We don't usually do large quantities because we're a beginner class, right? And we're a little bit more cautious. So if you want to, you just do quantity 1, and it's going to be the same thing. But if you do larger quantities, it goes back to that, is it better to do a lot of small positions with large quantity, or is it better to do one large, try and get a large move with smaller quantity? Well, and in the beginning, like I said, we want to do small quantity on the perfect setup. So we can start with quantity 1, put your order in there. We need a trailing location. The strategy is that we're just going to be stopped out. Now, there was another stop out right there. That would have paid off if we would have been trailing. So we want to wait until we're getting 3 or 4 bars, 2 or 3 bars in our favor, and an opportunity where people are going to get into the market, start trailing one price bar back, and then they're going to get stopped out. So we put our order in there as if we're going to get stopped out, but instead of getting stopped out, we're going to get stopped in and take a position. Now you can do it with just quantity 1. Okay, there you go. So you got your $25. All right. So that's what we're doing. That's this little strategy of just getting stopped out, only being stopped in. Now, you can do this with a number of different strategies, but the idea of the scalp and trail is that we then add the trail. If we think the market's going to continue in the direction rather than just scalping. But then the question comes in, well, why even bother with the trail? Just do, max quantity and just do the scalp. Just wait for the market to go until everybody's going to get stopped out. And can you do this? Can you do it with a larger quantity? You can. These are big, deep markets. You can usually do this no problem. When I worked at the Chicago Board of Trade, there were guys doing this with 500 contracts at a time. Now, you don't always get filled, all 5. They obviously weren't getting filled 500 at a time. And we just got our hiney handed to us. So that one didn't work for us. We got stopped out. 115, 9, 8. Of course, when you do the big numbers, 15, we'd have made it. We'd have. So as soon as you do the big quantity, that's when Murphy's Law steps in and pops you. Try it again. If at first you don't succeed, try again. Mark doesn't have to move very far. Okay, there you go. You got your 15. Now we're up $580. We made our $500. We're done for the day. Could you keep going? Yeah, you could keep going, but is it dangerous? Yeah, this is a dangerous strategy. And you're not going to be at 500. You got to take all your commissions out of there too. So you're playing with the sidewinders. All right. You're playing when you do this strategy, you're playing with the um you're playing with the market makers. And the market makers don't like to give you money. You're down here playing with the market makers with this strategy, but you're kind of teasing the market makers is what you're doing. So you have to realize that you're a little thief in here and they don't like you. They hate you. In fact, they think you're a terrible thing. You're like a tick on a dog's ear. And they don't want you doing this. So be careful. Why do you have your stop set so far back, Lan? Why are you at 25? Well, because you don't want when you're in real it's not going. When you're in real money, they can see your orders. They can see both sides. And if they see a big old order sitting there within five, really close to 5 and 5, they're going to take your stop order before they take your limit order. They'll bounce it back and forth. They'll take them both, and you'll get like we did right down here, right? Right in here where they popped back. They got both of them. We got a little bit of a win. We got a little bit of a loss. So they hit both sides. They'll do that in the real money too. Have you done this real money? Yeah, I've done this a lot in real money. Is it dangerous? Yeah, it's a dangerous strategy. Can you do it? Yeah, you can do it. Be careful. You want to make sure the market's running and got to a point where there's going to be more people with stops. All right. If you're just doing it like when it's dead sideways market, that's not gonna. You're gonna get your hiney handed to you more often than not. But if you'll do it when the market's running and it's making a nice move like this, and people are trailing and they're going to get stopped out, that's where you're going to make your money. So that's the key. Timing is everything on this one. You want to get stopped out. That's the whole name of the game. All right. So here we go. Wait till we 1, 2, 3, 4 bars. Nice, 4 nice bars. That's what we look for. Like we're like, okay, we're in a nice uptrend. We want to go, go, go. Okay. But now we're going to look to get stopped out. Oops, I goofed. Okay, we want to get stopped out. We're looking for the stop out. All right, market, come back and stop everybody out. There you go. You just got stopped out, but you got stopped out with a profit. So you can see we're up $1,190 on this strategy. Now the market's going to turn and continue to go. Is it going to go up? Maybe we'll go up and get stopped out, or maybe the market will continue to rise. Danger, danger zone. No, we're going to get we're going to take our hit this time. Nope, we got it. All right, it went in our favor. We're up $1,475, and we're up $75 on our option. All right, so that's a scalping strategy. You don't have to do 14, but like I said, you can, question is it easier, better to do a very small trade with a large quantity, or is it better to do longer trades with smaller quantities? You have to decide. So the scalp and trail is that we would then come in and do the same thing, right? Only we'd add our trail. And this time we would look for a market that's going to take off and run. But this market's good thing we haven't been putting the trail on there because we just keep getting stopped out. Now, the other question is, would it be wise in our interest to come in here and say, okay, I'm going to look for this. I'm bullish on this market right now, so I want to see it rise. Need a pullback. We could play the scalp, the stop, and the stop. Okay, we got 3 bars. Here we go again. Okay, let's see if it's going to stop everybody out. So this is just the opposite of what we generally do. Generally, we're looking to try and get into the trend, right? So we're looking for that reversal, red to green, red going into the green new trend. So this is bullish. So we should be long right now with everybody else with our trailing stop. But our trailing stop this time, we're going to get stopped out. We want to get stopped out. Okay, It did. Oh, what happened? How come did we lose on that? I don't know. We lost on that one. That was weird. Okay, now we can do our scalp and trail. So I'm going to do a scalp and trail. Oh, we won on that one. Scalp and trail. I didn't have enough time. That one went too fast. I want to show you. Well, we could do a scalp and trail. Let's just do it in reverse. I'm bullish on this market. I want to get into the trail to the long side, but I'll show you. We come in here, we put our scalp in. Now you just want to do the scalp on if you think the market's just going to stop everybody out as the market's rising. But then we come to a lower quantity. We could do quantity 1 or we could do quantity 3 and drop in our trail. Oh, I can't because I got too many. My max position sizes. Did we just win that one? Oh, that's weird. Lost 27. That's probably slippage. I don't know. So we're up $1,550 right now. Let's do 7. Let's do 10. We're going to do 10. So we're going to do 10 on this one, on the scalp, and then I'm going to change it to 2. Oh, and I wasn't fast enough. Okay, we just closed out. We're at 1,755 on the long side. And I meant to get my trail in there. So I wanted to change the quantity of the trail to 2. So we scalp out, in that case was 10, and then I was going to trail with 2. We change the quantity and then add the trail in there and stay into a longer position so we can't get a longer trend out of it. Not that I think the market's going to trend real big right here, but we're coming into 3 times a charm. Charm 1, charm 2, charm 3. Or this could be charm 1, charm 2, charm 3. But it's not charming on us. It's not charming for us. Okay, we just want to get stopped out. That's the name of the game with this strategy. A lot of advantages, but there's also lots of disadvantages with this strategy, so be careful. Okay, it's coming down. Oh, we missed it. I don't like that one. We'll see. It's a continuation to the downtrend. Bounced off of the 100-period moving average, started to rise again. This one this is charm 3. This is 1, 2, 3. This is the one we should be long on with our trying to take a long position. Now that's not enough bar. I don't really trust this one to come back far enough to stop us out and give us a profit because there's only come on, there it goes. It did it anyway. All right. I was a little worried on that one. We're at 1830. Let's stop right there. All right. Let's come in and talk about what we did. Let's come in here. And that's just the scalp side of our scalp and trail. That's all that was. And we just tightened it in a little tighter from 5 to 7. You could try 6 and 7. You could just do 6 and 7 and do the same thing. See if it doesn't want to pull back a little bit more and give you a little bit better than $25 on each one. But you got to take your commission out of there. So think about $20 each one. All right, where's our spreadsheet? Now, in our spreadsheet, how come my spreadsheet's not coming up? Yesterday, we did the dollar cost averaging. Remember that strategy? We did what I call the Balaam's ladder. So where is Balaam's ladder? Do I even have that in here? Oh, I have Balaam's ladder. Balaam's ladder is right here. So this was the strategy we did yesterday. Let me find it. Balaam's ladder. Now I ran Balaam's ladder. Here's Balaam's ladder. This is what we did yesterday. This is Balaam's ladder strategy. So what you do is you say, okay, I think the market's going to go up and eventually turn and fall. and I'm going to make a profit, but I don't know where it's going to turn and fall. So I'm just going to keep dollar cost averaging into the market as the market rises, and then I'm going to catch that big move down, and I'll have lots of contracts. And that works really well until it doesn't. All right? Works really well until it doesn't. Now, the opposite side of this is the Christmas tree, right? Here's the Christmas tree side. So the Christmas tree is when the market falls and you're like, well, I don't know where it's going to turn and rally, but I really believe it's going to turn and rally in here somewhere. So you just keep accumulating positions as it comes down and then look for it to turn and rally. Now, this comes from the strategy that a lot of investors will do over in the stock market, right? Where they're like, okay, well, I don't care. I'm going to buy Tesla. And as it keeps falling, I'm just going to keep buying more Tesla. All right. I've done this with Bitcoin. As the market keeps falling, I just bought a little more Bitcoin, bought a little more Bitcoin, bought a little more, and it's paid off really well for me. I've done really well with Bitcoin. Right now, Bitcoin's been coming back, and I'm sitting in a little drawdown on Bitcoin. Don't like that. Doesn't feel good. But that's the Christmas tree Balaam's ladder strategy. All right. So Balaam's ladder is the other side of that. Now, the reason we call it the Balaam's ladder is obviously because in track and trade, all of your sell orders are red. So you're playing with the devil. And there is no top. The market can just keep going forever. Not that there's really much of a bottom either. The market would have to go all the way to zero, but it could go to zero and stop, and then you would he'd be out of law. You can't lose any more than down to zero. But with Balaam's ladder, the market can go up forever. There's no top. So that's why you're playing with the devil. But you've also got the red Christmas tree in there. So the red bars in there, sell orders are red. So you're playing with the devil with this strategy. And this is what we did yesterday. All right. So yesterday we played with the devil. Now, this is also a strategy that when you're doing when you're selling premium in the options world, you can, instead of buying, say, a call option as your hedge, you can do this. You can Balaam's ladder, and what it does is it actually moves, doesn't physically move it, but mathematically it moves the delta cone of profit. All right, it moves it up and down. It's called a delta neutral cone of profit hedging strategy. And I've done this before, and I don't like it. Not a really good. It takes a lot of work. You have to sit there all day long and manage your position, and then at the end of the day, you make a couple $100. So that's my experience in it. But I wanted to document that strategy, so it'll be in the August issue of Pit News Magazine, where you can hedge your position with options, or hedge your options positions with Balaam's ladder. And we do it on two different time frames. So you put your option over on the mini market, and then you do this hedging strategy over on the micro mini market. So you have 10 opportunities, right, to add into your position against one option. So that's why you hedge it in the micro mini, but you hedge the option in the mini. And that's how you do that. You play Balaam's ladder or the Christmas tree, depending on which direction the market goes, right? I mean, if the market goes the other way, you're going to Christmas tree it. So that is a fun strategy. But the way we did it yesterday, or on Friday, is we got into that market and we just kept going up, 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 up. And the market never did turn around and fall for us, not during the opening session, right? But we had that order sitting in there at break even. So this is what happened during the opening session. We lost $6,225 because we thought it was going to fall, right? We had that position and we were waiting for it to fall, and it started to fall, and I thought it was going to come back far enough to stop us out, and it didn't. Came back out, stopped us out. We lost even more money. And then it started to go sideways. And then I was like, okay, let's try it again. So I stuck one in there, dropped my order in, had to run to a meeting. And when I came back, the market had fallen far enough that it hit our limit order, and we got our money back in the aftermarket session. So here, I'm going to read my notes. The market went into a huge 3-drive pattern. I took the short position at what I thought was going to be the top. I used a market order to enter short. Of course, as fate would have it, the market continued to rally, and I continued to play with the devil running the Balaam's ladder strategy. Markets can stay irrational longer than you can stay liquid. I think Bruce threw that out yesterday, and I got my hiney handed to me. I was able later in the day to catch the falling knife. I set my take profit limit order at break even and was able to recover, but it was one nasty trade, something I never wanted to be caught doing again, or, especially not with real money. Note to self, don't do that. And I've got, every time I've done this, I have notes to myself say, don't do that. All right. And then the next time I got paid for doing the wrong thing. I tried to dollar cost average into the X3, but took it way too early with a market order and got my hiney handed to me. I was able to recover when the market did finally fall, but it was one nasty trade, something I got paid for doing the wrong thing. Note to self, never do that again. All right. So that was a good thing never to do that. We ended up with $232 once that thing fell, and I had the order just right neck and neck to the position, but I had 15 contracts, so it paid off with a $232 profit. But that was one nasty trade. And those of you who are here on Friday, you saw that occur. And if you didn't see it, go watch that video on Friday. It was a nasty position to get ourselves into, and we ended up with a $6,000 loss, which is really ugly when we're trying to go for a $500 day. Actually, our days are now supposed to be, our goal is supposed to be $637. Our max loss, we're supposed to stop trading right now, $1,293. All right. And we went all the way to 6,000 because the problem is you get into that dollar cost average strategy, and you keep thinking, well, if the market will just fall, I can get my money back, or I can get to break even, or I can, make a whole bunch of money because I got a lot of contracts on. If it falls really far, I could make a lot of money. And you keep adding on, and your losses keep getting bigger and bigger, and you blow past your max loss very easily, your daily max loss. Now, the daily max loss is set. It's just double this. So our 1% goal is $646 a day, right? But our daily max loss is 2 days. So we won't only want to be able to, if we start losing and we get into a losing streak, we only want to have to take 2 days of winning days to recover. So that's why we have a daily max loss of 1293, which is just double the 643. Look at the formula. See, it's just L16 times 2. So that we only have to recover 2 days. If we'll keep in mind that we don't want to lose more than 2 days of profit, a regular daily goal, then we're going to be, that's our risk and money management strategy. Remember, count, measure, setup, trigger, and follow through. The follow through is the risk money management setups and strategies. We want to make sure that we're not risking too much money for the profits that we're going to take. And we're going to put a high probability on the winners. Okay. So what have we done today? So far today, let's come over and take a look at our trades. So we got stopped out with profits of $1,830. So let's go back over and put that in there. $1,830. $1,830. And our option is up $100. So our option is currently, let's go look at that. Our option is up $75, $85. So let's go back over to that chart. And there we go. So our option Okay, so it came down and it's starting to rally. It's continuing higher. And we got our limit to take it off at 225, right? I think that's what we said. So we got an order in there to liquidate right there, sell our call limit. And so that's working. It's waiting to take that thing off as soon as it hits $225. All right, and we're up $100 right now. So we're outside of our cone of loss, and I accidentally deleted that, so I apologize, but it would be, something like this right now. Be on an angle, something like that. So we're up above it, up above our cone of loss by $100. Take it, land. Take it right now. Take your $100. Take your $100. There's the peak. It doesn't want to break above it. It's going to go up there and fall down. It's going to come back down. Oh, get out. Get out. No, we're not going to do that. We're going to stay in on this one for a little while longer anyway. We'll see if it'll take $225. That's what we're looking for. We want to see this market rally enough to give us a little bit of profit. Wow, look at that Dow. That Dow's nice. The Dow's been really good lately. Can't believe it. All right, let's bring this down. And a lot of people are going to say, well, Lan, what is the software you're using to do this amazing style of trading? You're so amazing. I want to do what you're doing. All right, well, it's really simple. Just go over to Track and Trade right here, trackandtrade.com. Download the software. That's the futures version that we're trading, right? It has no pattern day trading rules. So you could do this with a $5,000 account. and go ahead and start day trade to your heart's content, because we're in the futures market out of Chicago. We're not trading out of New York where they have those lousy day trading rules. Did you hear that Texas is opening up an exchange? Yes, sir. Texas. Texas is opening up a new stock exchange. Why? Because they hate dealing with New York Stock Exchange, NASDAQ Stock Exchange, American Stock Exchange. They have rules that they don't like. And they're getting all woke on us. They're making it say that if you're going to have your company listed on the NASDAQ, you have to have diversity and equity. You have to have gay people on your board. You have to have, uh, any underclassed people from black or Mexican or brown or any other, you have to have, they force you. It's like, no, I just trying to run a business here. I want to have the best people. If the best person is a gay person, great, I'll hire a gay person. I have no problem with that whatsoever. But don't tell me I have to have a gay person, because I can't find a gay person who's going to fit this mold, but I have to if I'm going to be listed on the NASDAQ exchange. Can you believe they're doing that? Of course you can believe it. This is New York City. Of course you can believe it. You're going to have gay people on your, or black people or brown people or yellow people or whatever, just because of the color of their skin, not because of their skill. And they're going to force that on every company that wants to be in the New York Stock Exchange. This is why. And I don't think America is a racist country. I don't think we are. We just want the best. And if you're the best, you can fly our planes. We don't care. You want to be gay? We don't care what you do in your bedroom. Go do what you want. But if you're damn good at flying an airplane, we're going to put you in the cockpit. But if you're not, we ain't going to put you in the cockpit just because you like to do nasty things in the bedroom. That does not cut it here in America. We just want the best people at that skill, and we don't care what you do in your bedroom. But just because you do that in your bedroom doesn't mean that gives you a space in the left seat of an airplane. That's not the way it works. But that was the olden days. Nowadays, that's the way it works. So that's why Texas is saying, screw that. We're opening up our own exchange. And people who want to list their companies on our exchange don't have to have these equity, diversity, and crazy, crazy rules like they have in New York. So there you have it. Let's trade in Chicago. Chicago, come and get your live futures chart, and we'll trade out of Chicago instead of out of New York. If you want to trade out of New York, New York is New York. We like the stock market, but I'm looking forward to the Texas exchange. That's going to be a lot of fun. All right. And then, of course, you got Pitt News Magazine. And all this stuff that we do in here is going to be documented in Pitt News Magazine. So you want to go get that. First 3 months are only $1, and then it's $49 for the entire year after that. And we make it so that you can listen to all the articles. You don't have to read them, although they're there. So you got the great articles as well. So go sign up for Pitt News Magazine, where you're going to get all this documentation on what we're doing in this trading club and in this trading class. And there you have it, folks. That's my presentation for today. We're going to do this a little bit more. We'll do it again tomorrow, and I'll show you the settings once again. We'll practice a little bit more. We want to get stopped out with a profit scalp. And we're going to try and do a little scalp and trail again tomorrow. Actually, tomorrow is going to be Power Hour. So let's do scalp and trail on Power Hour tomorrow afternoon, the last hour of the day. For me, that's 12:55 Mountain Time. So we'll see you tomorrow, and we'll do it again. All right. All right. If you liked it today, you felt like we did a good day, go ahead and hit that little thumbs up and subscribe, and we'll do it again. We'll see you here tomorrow for Power Hour.